Will Salesforce's faster stock buybacks move the stock and even your index fund? Here's what the acceleration really means for investors and how to read the signals. Salesforce is leaning on stronger margins and bigger cash flow to retire more shares. That matters because per-share metrics like earnings per share and free cash flow per share can rise when the share count falls. In markets where capital return policies drive sentiment, companies that step up repurchases often see a valuation re-rate, especially when the cash comes from operations rather than new debt. With rates still elevated and the economy evolving, a steady buyback can also offset dilution from stock-based compensation and cushion periods of earnings volatility. What changed is the shift from authorization to action, and from financial engineering to operating discipline. Salesforce moved from no buyback history to a $10 billion authorization in 2022, then lifted the program to $20 billion in 2023. That signaled a new priority on returning capital. The company's non-GAAP operating margin topped roughly 30% in fiscal 2024, which gives room to fund repurchases without starving core investment. Free cash flow reached about $9.5 billion, supported by recurring revenue, which suggests capacity for ongoing repurchases through different parts of the cycle. Management has also pulled back from large acquisitions and focused on cost control and organic efficiency, freeing cash that previously went to deals. For the market, accelerated repurchases by a large-cap constituent can nudge index-level earnings higher, influence sector allocations, and redirect ETF flows. It can also project confidence in the intrinsic value of the stock, a signal peers may echo across software. There is a modest headwind from the 1% federal excise tax on net buybacks, which companies weigh against dividends and reinvestment, but it is unlikely to derail a cash-funded program. If you own Salesforce directly, watch the diluted share count trend, the pace of buybacks versus free cash flow, and whether repurchases occur at sensible valuations. If you hold broad tech ETFs or index funds, understand that consistent buybacks from giants like Salesforce can be a silent tailwind to per-share earnings. For option traders, note that lower float over time can affect liquidity and volatility dynamics. The takeaway is simple. Sustained, profit-driven buybacks can lift per-share value and stabilize results, but they work best alongside healthy growth and disciplined spending. Read the full article at finlitica.com. Quick reminder, this is general information, not financial advice. Your money, your decisions, so always do your own research.